A-level macroeconomics question. Right? During the 2009, the Bank of England engaged in what is known as quantitative easing by pumping more than 200 billion pounds into the economy. Record low levels of interest rates may have also been maintained within the UK economy. Quantitative easing and low interest rates were also adopted by the US. The questions: explain why exchange rates rather than interest rates are the preferred choice as the instrument of monetary policy in Singapore. Discuss the likely impact of the Singapore economy of quantitative easing and low rates, interest rates in the US and in the UK. All right, let's get a few things into perspective first. My colleagues before me have repeatedly reminded you that when the preamble does exist, it's a preamble, right? So when it does exist, the stem here exists. The longer it is, the more you got to read, make time to read it carefully. Okay? All right? And then I would also like to stress that when you look at it, there is a certain purpose where the stem is situated here or elsewhere. Some of you will just jump into here, so do not do so. Beginning with the end in mind, if you are focused on what's going to come on Friday, in terms of what certain is this, okay? As an assessor, we look for your knowledge and understanding of economic concepts, theories, principles. We look for your ability to interpret and evaluate given information, all right, well, however it's presented, and making valid inferences from the information and evaluate the reliability of information. Thirdly, most people are able to do this, apply relevant economic concepts, theories, principles to analyze the issues, perspectives, and policy choices, and construct coherent economic arguments. And lastly, the evaluation. Evaluate critically alternative theoretical explanations compared to what you already discussed here, all right? And then recognize unstated assumptions and evaluate the relevance. Synthesize economic arguments to arrive at a well-reasoned judgment and decision. Basically, you have a question, you break it down to the parts, and then you analyze each part. Okay? That's basically the focus of A01 to A03. You're analyzing each part. Then after that, you synthesize, put it together. That's why your concluding paragraph is very, very critical. If there are so many factors there, you got to put it together. If you're talking about the market, ADAS, if there are factors affecting the demand side, whether it's micro or macro, factors affecting supply side, micro, macro, you can analyze it separately if you want to, but eventually you need to put it back together again before you pen off, before you hand in the essay. All right, so be clear that this part has to come in. At the same time, this is the higher order thinking that you illustrate, things like the limitations, the conditions, the situations, the context, and things like that. Okay, so be mindful about that. Okay, so now putting that into perspective, so therefore, I'm going to proceed from there. Okay, the question is presented in this manner. Okay, all right. So, some of you will have this habit of, you see things differently from us. Some of you see it like that. This is the question. Some of you see it like that. Okay? Honestly, if this was what the examiners wanted, they would have done this. Okay? So that means the preamble, why it's called a preamble, amble is what you do here. Another meaning for amble in English language is a stroll. That means it's something very easy for you to do. Assumption. Okay? All right? Something that's easy for you to do. So before you go on your leisurely stroll, take note of the conditions that you have to, before you do this. So that's why it's called a preamble. Or if you consider this a stem, these are the branches that comes out from the ideas here. Okay? So be mindful about the purpose of this. Okay. If you do this, that means the value of this is not related to this anymore. Actually, there's a purpose. Okay? And some of you, my worry, you have this habit of doing this. You remove the preamble totally. Okay? Because it's supposed to give you an idea, the context and the parameter that we're talking about. Okay? So be mindful about what you're looking at. Right? So if I go back again, right. Okay. So look at the preamble. Bank of England engaged in what is known as quantitative easing. Do you know what that is? By now you should know, but at that point of time, 2012, when the students were looking at it, they may not know. So the preamble will give some hints. By pumping more than 200 billion into the economy. Okay? Who pumped it in? Which economic agent? Government. Government pumps money into the economy. They use the term pumping. All right? And if you know Singapore government, they will also do pump priming. Okay? So when the government pumps money into the economy, what kind of theoretical policy is it? Right. Some of you were muttering the word fiscal policy. Right? That's precisely why they use the term pumping, because they want to allow the slippery slope, the banana skin. You're not very sure, then you slip and fall. It is not fiscal policy. Okay? All right? That's the thing. Precisely, you've got to read carefully. And I understand some of you may see it as that because you see the two sentences as being separate. Okay? And then after that, record low levels of interest rates have also been maintained. So because of that sentence, you think the previous one is a separate one. Okay? All right? And then, okay, so why record low levels? In my previous lecture, when I did the macroeconomics coverage, I did stress that the whole economy, the whole global situation at that point of time, the interest rates are very low. And I did hint that the reason that it's very low is because you want people to borrow money to generate economic activity. So they want to keep it there. But again, why did they say the interest rates are like record low levels? Why didn't they highlight a change, lower levels? It was maintained at a low level. It was not lower. It was not lowered, because only when a change happens, then there's a reaction. Okay? So there is no indication of lowering. So how come? There must have been a problem there. You understand? So that's the thing that you need to read carefully. Okay? And then now they're saying US and UK. But then the first question never asked about US or UK. Mentioned about us. Okay? All right? So, if you take, like some of you do, if you are selective in your reading, you take the last few words, interest rates were also adopted by the US, that will ring a bell. What policy? Monetary policy, interest rate based. Okay? Then you would probably think, okay, my recall mechanism gets going, recall machinery gets going, interest rates in the context of the global world in 2009 is just recovering after the recession. Okay, the financial crisis. So in other words, in my previous lecture also I mentioned the landscape is all the economies shrank. A large number of the global economies shrank. So therefore, if I'm going to piece that information and the interest rates, what kind of monetary policy is it? Contractionary or expansionary? Obviously it's expansionary. Okay? Then the question becomes, if it is expansionary policy used by US and UK, two major economies in the developed world, why would another similarly developed economy choose a different stance? Okay? All right? So now they are challenging your understanding why this tiny red dot called Singapore would adopt a policy different from the other major economies. Okay? So that's the idea. All right? Okay. So again, this is one thing you need to consider. They already hinted to you. In the question says, explain why exchange rates rather than interest rates are preferred choice as the instrument of monetary policy in Singapore. Most of you will read without the last two words in Singapore. So you go on to talk about theoretical monetary policy. But you know monetary policy in Singapore is the exchange rate policy. All right? So therefore, the choice is different. So therefore, they're testing your contextual knowledge one. Okay? Back to basics again. These are discussion about policy, not fiscal, monetary. Monetary policy got two versions, interest rate based and exchange rate based. Question now, if you implement these two, what is the fundamental goal that the government try to achieve? First one will be economic growth. Everybody will think like that. And then you go on on a roll. Economic growth, employment, then price. I look at the horizontal axis, then I look at the vertical axis. Then after that, the other things, the balance of payment. Okay? If that is the priorities, then the choices is no different between Singapore and the others. So there must be a certain uniqueness about monetary policy in Singapore. So that's why they're testing your contextual. AO2, assessing the information presented, evaluating the information presented. Not just monetary policy, but monetary policy in Singapore. Okay, be mindful. All right, so that's the first thing. And then, right, now, if Singapore were to use the interest rates, Singapore lowers the interest rates. How for Singapore to grow, they lower the interest rates, what do they need to do? They need to increase the money supply, correct? You know that. So if money supply has to be increased to lower interest rates, will the sequence of events, lower cost of borrowing, more consumption, more investment, all that happen, given Singapore is doing it? All right? Okay? If any country, an open economy, lowers interest rates, what will tend to happen? The sequence that we know may not happen because there will be capital outflow. When there's capital outflow, the money supply, again, will fall again. Interest rate goes back up again. So if you're aware of that, the monetary flows for Singapore, again, makes it not prudent, not wise for Singapore to use the interest rate-based monetary policy. So it's about capital flows, flows of funds. That's why this preamble becomes important. The government pump a lot of money in UK and US. Now they're trying to tell you, I give you money, go and spend. But firms get the money. Are they confident to invest? No, not confident, but the government lend me money. I'm supposed to pay them back principal sum plus interest. Where do I make the interest? Where do I make the earnings? I obviously got to put somewhere where the interest earnings will be higher than what I owe the government. So what happens with the funds? It flows elsewhere. So again, it's about monetary flow again. So the whole thematic thing is about capital flow. How it affects the two scenarios. The country here and this country here. You understand? So you cannot move this preamble in between here and then you ignore the idea of capital flows in the discussion here. Okay? You may not be entirely wrong, but it is also critical. Okay? Clear? So look at the question, understand the role of the preamble. Okay, so now if I go to this one. Now, let's look at this. Explain why exchange rates rather than interest rates are the preferred choice as the instrument of monetary policy in Singapore. It's not asking you explain whether. If the question was explain whether, then you can say, no, interest rates is a better choice. Now they've already decided for you. They've given you an ultimate, definite outcome. Exchange rates is preferred. So therefore now, prove to me why it's preferred. Okay? All right? But you know it is implying two different instruments. Okay? And another thing is, if you're going to recall from our previous memory, this question is very familiar, right? You've done something similar to this, right? A few chapters ago. To freshen your memory, the CSQ, question B1. Only difference is, so if you remember what your answer's here, that's the crux of the answer, and therefore you need to learn to expand. Because the moment you expand the idea, it's an opportunity for the market to see whether you understand. Okay? Some people will list certain points, some people will be able to explain those points why they are important. Remember the answer here? When you did this? 2 keywords, small and open. Okay? Alright? So let's go back to the question. So, AO1, the concepts is exchange rate and interest rates as monetary policy in Singapore, AO2. Not just monetary policy, but monetary policy in Singapore. So now I'm asking myself, what is monetary policy in Singapore? And what is the objective of monetary policy in Singapore? Do you know? Typical, right? Economic growth, right? Right? Okay. Just to give you the details, this is what it is. It sits there Since 1981, monetary policy in Singapore has been centered on the management of exchange rate. Primary objective has to be promoting price stability. Not growth first, but price stability. So this is where, in the tourism board's tagline, uniquely Singapore. Okay, we do it differently. Okay, all right. As a sound basis for sustainable economic growth. All right, not just economic growth, sustainable. In other words, by definition, a prolonged period of growth without worsening any other things. In your conceptual knowledge, sustainable means what? Doesn't worsen the environment, doesn't worsen the depletion of resources. But then Singapore don't have that much resources. How to deplete? Or they deplete faster, right? Yet, small quantity, how can it be sustainable? It's amazing if a small quantity of resources that Singapore has and they can maintain it for so long. Okay, so that's where the test comes in. And then they say the context of the small and open Singapore economy. That's the nature of the economy coming in. Okay, all right. And then how do they achieve this? Direct interventions in the foreign exchange markets. Okay, direct interventions, buying the Singapore dollar, okay, in the foreign exchange market. Then, so these are the key things that describes Singapore's exchange rate-based monetary policy. Okay, and so this is the background. And for those of you who are relying on your background of recalled memory, this was your case study question. This was a typical point that you're supposed to answer this, and then this was a typical sum of the ideas. May not be the same, but these are the things. Okay? So if you did the case study diligently and you remember the learning points about the Singapore economy, these points are the core of your answer to this question, part A. Okay? Can? All right. Okay. So again, this is our recall. So I've shown you the assessment of what the markers look out for. And if you look at your syllabus, it brings in the decision-making framework. So now I'm going to look at the question using that framework. Okay? This is the decision-making framework. This is the decision they want to make. And in the question, the decision made is exchange rate is the preferred instrument. Done. But who is the economic agent that is making that decision? Out of the three, it is this fellow here, government. Okay? And then this question asking you why, the question was explain why exchange rates rather than interest rates are preferred. Therefore, they want to know how did that outcome came about and what are the considerations. So the 5 things here are the considerations. The constraints, the costs, the benefits, information, perspective. Perspective, obviously, we're looking at the government's perspective. So certain questions I ask myself would be this. If this was the question, then is the decision made? Yes. Okay? Exchange rate is preferred. Whose perspective? What information do I have of the context? Which is basically what's the nature of the Singapore economy? What constraints does the country have? What are the intended consequences or unintended consequences or the benefits and costs of the decision? Okay? Policy effect of NPUs in Singapore, is it different from UK and USA? In terms of the sequence of effects, in terms of the priority of effects? All right? Is the outcome intended or is it unintended? Okay? So these are things. Okay? Again, you need to ask questions to understand things better. So to answer these questions, perspective-wise is the government. Nature of the economy, small and open. Constraints, small and open. Implication of small is resource scarce. All right? The implication of open, mobility of resources, which includes funds, capital. Okay? And then small also means your product, okay, market is small. So these 3 things. Okay? Thirdly, benefits and costs. Obviously, policy, the typical expectation of the outcome is your YEP, BOP. Okay, generically it's these 4 things. But if you know Singapore doing it differently, then based on just what I showed you, promote price stability as a basis for sustainable economic growth. So the sequence come in first. This is the banana skin. Price stability, what does it mean? Can it be a price increase or is it a price fall or must the price be the same all the time? Okay? What kind of price? Domestic price or external price? Okay, what are we talking about? Okay? So these are the key things. So if I'm going to use the decision-making framework, these are the ideas that comes out. Okay, so therefore I need to explain now what are the decisions that the government did to arrive at it. Okay, my students always ask me, what do I write at the introduction? Okay, the last time I was here, I told you, it's basically background, concepts, and direction of the question. Okay, so this is my sample introduction. The contagion effect of the 2008 financial crisis, the most dangerous crisis since the Great Depression of the 1930s, the world economy had faced, began in 2008 when sky-high home prices in the US finally turned decisively downwards, spreading quickly first to the entire US financial sector and then to financial markets overseas. The carnage was not limited to financial sector, as companies that normally rely on credit suffered heavily. Banks, trusting no one to pay them back, simply stop making loans, and that most businesses need to regulate their cash flows, and without which they cannot do business. By the end of the year, a deep recession had developed most of the globe, with none of the biggest economies prospering. There was no obvious engine to pull the world out of its recession. As such, and now I want to link it to the question, as such, governments all over the globe had to find their unique ways towards economic recovery. That's why Singapore does it differently. See, I'm laying out the foundation to it. Okay? How to achieve something like this? Mr. Nadan also upped the ante the other time. Okay? So how to do this? Read more. Okay? Again, this is with the A-levels in mind, because it's an A-level question. So then what are the concepts? The concepts in brown, the direction of the question is in green. Monetary policy involves the manipulating its tools, that is interest rates and or exchange rate, to affect the country's level of economic activity and achieve its macroeconomic objectives. Why I have to give this? Because my students, when they write about policies, they never define the policies. My students, please take note. Okay? All right, next. I don't know, other classes, other students must be very good. My students are the ones not so good, I think. Okay. No. Okay. Or maybe my students better, never mind. Okay, next one. Singapore's choice of exchange rate over interest rate as a tool of monetary policy can be explained by the small open nature of its economy. I'm already laying the foundation to the ideas I want to discuss in the essay already. Specifically, being reliant on imports from other countries makes Singapore vulnerable to imported inflation, which can be effectively mitigated with a strong Singapore dollar. The fact that Singapore is an export-driven or trade-driven economy also makes it necessary to maintain exchange rate stability in order to not destabilize trade relationships. This may be somewhat different in approach from the monetary policy interest rate base that most other economies would undertake to promote economic growth. Again, I'm highlighting the fact that Singapore does it differently, uniquely Singapore. Okay? All right? So this is the idea. Okay? All right. So therefore, now how do I justify based on the characteristics of the small and open economy? Obviously, small and open economy implies that they are resource scarce and they are import reliant. So therefore, you got to explain what are the things that do they import? Obviously, raw materials. Sometimes intermediate products. Sometimes final goods. Okay? We bring in final goods so that the Singaporean middleman has something to sell. Okay? Implications of this. Because it's our raw material, either one of these three, we are vulnerable to unfavorable price changes in other countries. So inflation in country A will affect us. Inflation in country B will also affect us. So that's what we call triggering imported inflation. Imported inflation is which type of inflation? Cost push. Well done. This group, well done. Okay? Okay. And then, again, point made. Like my students, I keep telling you, it's point, example, or evidence, explanation. So therefore, examples will be this. Okay? The Middle Eastern instability leads to supply shocks, and since they are global oil producers, global oil prices will always increase when there is turmoil in the Middle East. it affects Singapore by raising the cost of production, and therefore Singapore suffers by having imported inflation. Okay? So that's the scenario. So therefore, how does this problem get addressed by the exchange rate policy? So now it comes in. This is what Singapore does. Modest and gradual appreciation of the Singapore dollar. Singapore very modest about everything they do. Okay? All right? So the effect of this will be the price of imports in Singapore dollars will fall. Okay? In Singapore dollars will fall. In their own currencies, it didn't change. But in Singapore dollars, it fell. An example, MAS tighter monetary policy stance between 2008 to 2010, which is during the crisis, to cushion the effects of higher global oil prices. Okay? There was a financial crisis, at the same time there was an oil crisis. So it's a double whammy. Okay? All right. So how does Singapore do this? This is an A-level question, so you will be expected to know the Singapore's exchange rate. I think the other day Mr. Nadan showed you something. So basically, the basket, the band, and the crawl. Okay? I'm just showing you the things, but after that I show the simplified version, yeah? It means this. The exchange rate is over a weighted basket of currencies. Whose currencies? Major trading partners. Who are our major trading partners? The people we buy resources from and the people we sell to. So those currencies will become part of the basket. The countries we buy resources from, their currencies are included. The countries that we sell our products to. Okay? And then there is a policy band, which means to say, if you remember your price controls, you have the upper limit and the lower limit where the exchange rate can go. That's what they need to control. Okay? The crawl simply means how they adjust. Whether the band becomes narrower or wider or whether it goes up over time, that's another thing I will show you later. So basically, Singapore exchange rate is like this. If this is the equilibrium, if the economy, if there's transaction demand for currencies or whatever, as long as the exchange rate is within this band, the government doesn't do anything. Okay? This upper band is determined by the exchange rate of the countries that they sell to. Our exchange rate cannot be higher than this. Otherwise, we lose our export competitiveness. Our exchange rate cannot be lower than this, because these are the currencies of the places we buy resources from. So we need to maintain somewhere in between. Okay? All right? So it's a balance of the two things. Can? Get a picture? So this is, all right? Okay. Okay. So that idea. So anywhere in between is it. Okay, this next few slides I'm going to go a bit faster, because you may not know it now, but just giving you now, later you can use. Next year. J2. Sometimes the government will modify the slope. This is the gradual appreciation. It goes up. Whether it's going to go steep or gentle, that's how the rates will change. Okay? Sometimes it's like that. They widen the band because they don't want to intervene too much. So they widen the band, allow more latitude for the fluctuation to happen. Okay? And thirdly, okay, they can move the whole thing upwards because the targets change. In the center is the target, so when they move all up, the target's exchange rate changes. Okay? So these are the basic stuff. We'll go more into detail in J2. So just giving you the ideas now. You can come back to it later. Okay. So which means Singapore tries to maintain a strong currency. So what is the effect? Direct impact of the currency appreciation through AS. You know this. Okay? Reduce import price push inflation. Imported inputs are now cheaper. COP falls. SRAS increase. SRAS curve shift downwards. You know this. But there is also a secondary effect because of the appreciation. Okay? And this happens. Okay? So do take note. Can? Alright? Okay. So in other words, demand will fall also slightly. The belief is the fall in demand will not offset the growth that is achieved by the lower cost of production. Okay, so that's the nature of the economy. All right, when they use the because of their resource scarce. And because they are a small domestic market, okay, it's export driven. Okay? So, for example, if the economy is facing a global external recession like the 2009, okay, and these are the potential threats to the economy, what the government can do is, the words they used before was zero appreciation, and to simplify your analysis, you can take this as a depreciation, but I have to stress the word marginal depreciation. Okay, the depreciation is not very big because we can't afford that. Okay, how much did the Singapore government depreciate it during the crisis? Any guesses? Not double digits. Okay, they allowed a 2% depreciation to prop up external demand. Okay, all right, and the transmission, you know this. Okay. And the effects again is the YEP and BOP. You can go on to that. Okay? So basically these are all the links to it. Okay? So the discussion about exchange rate done. Okay? The benefits of using exchange rate. Now, why they didn't use interest rates? So this will be the case. Why is it not preferred? You still need to explain the policy. Ideally, they would achieve growth also, but the growth is achieved by increasing the money supply. The bank rate is one of the tools of monetary policy. My students always ask me, is it interest rate first, then money supply, or money supply first, then interest rates? Okay, so I want to use this opportunity to correct you. This one is the penalty rate. The central bank charges the commercial banks for very poor fund management. What do I mean by fund management? If you put a deposit into my bank, I have an obligation to keep, let's say, 30%, and I can lend 70%. But if the more I keep, the less profits I make by lending people money. So sometimes the banks will want to take risks, so they will lend more. But if they lend 100%, comes along the depositor who want to take the money out, the commercial banks do not have the money. Then it's in trouble. So therefore, it has to go to the central bank to borrow. Okay? Get some reprimand, scolding for a while, tap on the knuckle, then after that, they lend. Okay? So that's the idea. So when the penalty rate goes down, every other lender will also lower their interest rate because it's a market force. Okay? All right? So that's it. Okay? And then these are your typical analysis that you have. Okay? Can? All right. So this one looks good. Economic growth, employment, but prices rise. Okay, whereas the previous one, prices fall, there's growth, there's employment. Okay, so for Singapore, the other one is preferred. In this case, the limitations, one. First fundamental thing, they cannot control money supply because Singapore is a financial sector open to capital flows. Okay, any attempts to lower market interest rate, the moment there's an interest rate difference, there will be capital flows, either out or in. So the money supply will change differently from what the central bank wants. Singapore is an interest rate price taker. What does it mean? A price taker means the entity is so small, whatever it does, it cannot influence the market price or market rate. So in this case, Singapore is so small that whatever they do to the money supply cannot affect the global market rate. Okay? So hence, Singapore has to allow its interest rates to be determined competitively by the free market forces. They cannot influence it. They are not a monopoly. Okay? All right? Thirdly, small domestic markets presupposes that the impact of changes on interest rate on C&I are small, and because of the multiplier also, the impact on growth is very minimal. Okay? You have the CI component, you have the X component. You know Singapore is more growing by external sector. So obviously C&I is believed to be a smaller proportion. I use the term believe because yesterday when I checked the figures, the C&I is equally as high as X. So like that's how okay, cannot show you figure data already. Okay? But maybe back then I was trying to find the 2009, I couldn't find it. Okay? All right? Historically, C&I was a smaller component of aggregate demand than X and M for Singapore, historically. Okay? But right now, I'm looking for the data I couldn't find. So just stick with this idea. Okay. So therefore, again, so now you've proven that there's limitations for the monetary policy. Again, your conclusion, like all governments, Singapore chooses the policy tools keeping in view of their goals that it prioritizes. Singapore is a trade-dependent, resource-scarce country, hence keeping a stable and strong Singapore dollar helps the economy to maintain its goals. Third one, given the nature of the economy, exchange rate as its preferred monetary policy instrument, the government can ensure inflation is kept at its minimum so that it doesn't erode the export competitiveness as well as keeping domestic costs low, internal and external effects. Okay? So that's the thing. You tie up the benefits of using exchange rate and the constraints that tells you why you cannot use interest rates as a basis. Okay? All right? Okay. So, given these things, what did the examiners say about the students who did this in 2012? The second part to this part A, wide-ranging response in both breadth and explanations, which is the part B. The first part was less well-focused. Okay? All right? So the green one is for part B, then part A. Yeah? Okay? Part A, there were some very good responses, gave excellent analysis of both exchange rate and interest rate policies set within the Singapore context. That's a AO2. Answer using Singapore context. Most candidates know this, interest rate price taker, but couldn't explain. Okay? So explain that idea. You will learn how to explain this when we've done JC2 market structure. Okay? Then the explanation. I've already given you the definition just now, the idea earlier. Okay? Good explanations refer to open capital markets and hot money flows, while top answers also explain Singapore's investment demand is not sensitive to changes in interest rates. Basically, the small multiplier. So basically, I've covered all the key things. Okay? All right. Moving on. There was better and more consistent appropriate explanation of the effectiveness use of exchange rate policy. This one, students were a bit better. Interest rates cannot handle. Okay? On one hand, appreciation reduce imported inflation, while depreciation lead to export-led growth. Okay? The Marshall-Lerner condition, elasticity of exports and imports, the sum must be greater than 1. The quality and accuracy of this explanation discriminated. All right? So therefore, the use of this differentiated the quality of responses between students. Okay? Only small minority of candidates explain both interest rate policy and the exchange rate policy well. Okay? So that's the point they're trying to make. Okay? So know what they expect, and then you, okay, try to achieve that outcome. You can polish it up when you go to JC2. Okay. Okay. Part B is a bit more easier because you're quite familiar with these kind of things. Discuss the likely impact of the Singapore economy of quantitative easing and low interest rates in the US and the UK. Okay? So obviously, the policy stimuli is quantitative easing and low interest rates. That's the concept. That's the policy. But this policy didn't happen in Singapore. It happened in US and UK. So therefore, it is obligatory for you to explain first what happened in UK and US as a result of this policy. So that's one chunk. Okay? Then after that, whatever happens to this economy, how does it impact the Singapore economy? So there's a domino effect thing. Quantitative easing, interest rates low, affecting UK and US, and then affecting Singapore. Okay? And it's discussed, obviously. Are we going to say discuss? Yes, it affects. No, it doesn't affect. Okay? This is where I have a problem, because we tend to think that discuss is always two-sided, and then the two-sided the students give is, yes, it has an impact. No, it has not. Doesn't have an impact. Okay? All right? In fact, this discuss is like your GP. They want you to give more detailed analysis considering all aspects of the argument. Okay. Okay. Again, so background, key concepts, and the direction. Okay. So this is what I would do, explain what the QE is all about, okay? Basically, it has spillover effects on Singapore, all right? However, this is the other side of the coin. The hot money flows from these countries may lead to challenges from Singapore, so that's the impact, okay? So Singapore will be impacted by exports as well as capital flows, all right? And then in addition, Singapore is an interest rate price taker, okay? All right, which is closely tied to the US interest rates. The cost of borrowing may fall, remain low in Singapore in tandem with US. So that will also aggravate the inflationary pressure. Again, this is contradicting Singapore's goal of price stability. Okay. So effect of quantitative easing on US and UK, very straightforward. It's an expansionary monetary policy. Why they kept it low is because of the liquidity trap. Okay? So they didn't make it lower because they can't. Whatever they do to money supply cannot. Increases in money supply will not trigger further fall in interest rate. Okay? And they are also close to zero. I showed you the graph the other time round in the lecture before. So, okay? Again, the basic theory, expected profitability of investment will be higher, so therefore there's an increase in investment. It also boosts the spending on assets, okay? All right? And it also reduces opportunity cost of present consumption, so they don't feel like they need to save or they can borrow to spend. All in all, it leads to the recovery. So your liquidity trap is like that. Okay? So this is the basic idea with regards to the US and UK economy. Okay. So how would it in fact affect Singapore? This will become the trigger. Okay, and then the excess funds that they have, okay, in the economy will be also the other trigger. So, for Singapore, point to make, you know Singapore's exports will increase. Okay? USA and UK, I think if I'm not wrong, it's about 30% to US and something closer to UK also. So these two are our major number 1 and 2 trading partner in UK also. Okay? All right? With an increase in their spending capacity, all right, then imports from Singapore will increase. At the same time, because they cannot make money in UK and US because their optimism not very high, most of the 200 billion billion pounds from UK may end up in Singapore, for example. So that's your capital flow. And when it comes to Singapore, it can be here for a longer term. Some of them are still here in Singapore because it's making money in this region. So therefore, they didn't pull it back to UK. All right? So these are the bits. So FDIs and portfolio investment will increase. This term you're not familiar with, you will be more familiar with when we do international trade. So that one, save it till later. Effectively, this is what happens. Okay? So fundamentally, the 2 points is an increase in X and I, so therefore AD will increase, multiple increase in real national income for Singapore through the multiplier effect. Okay? So that one is quite straightforward. Can? All right? Okay. Other positive impacts on Singapore in the long run. Okay? Obviously, because of investments, your potential growth idea must appear. Okay? Improvements in BOP, because of the capital flow and the exports that we sell, we are earning foreign currency because of our balance of payment surplus. So on the whole, largely positive for Singapore in this respect. Okay? Okay. The negative one, obviously, I showed you the diagram here already before this, sorry. Prices will rise, so under the negative part, sustained increase in general price level is the consequence in the short run. Currency appreciation, because of a large capital inflow, it threatens our export competitiveness because our goods becomes more expensive to foreign countries. Okay? Hot money inflows will come in, which will again affect our currency appreciation. With it coming to Singapore, now in the local banks, there's a lot of liquidity. Naturally, the banks will want to lend more money, so there are more money circulating. Money supply will increase because there are more liquidity circulating within the economy. So when there's too much money chasing after too few goods, you have demand pull inflation. Okay? All right? And because banks want to lend money to people at low interest rates, people feel that they can borrow money and buy assets. So that's why in Singapore, property prices are rising. And some may fear that this is a property bubble which may burst if it's not kept unchecked. Okay? Not kept unchecked, sorry. Okay. So, the effects. To conclude, to analyze the net impact on Singapore's economy, we should look into both the direct effects and the indirect effects. I've only discussed the direct effects mostly, but you need to know also whether the capital flows to the other countries in in the region of Asia, for example, will affect Singapore adversely because Asian regions may be selling resources to Singapore. Okay? The impact of low interest rates and quantitative easing depends on, all right, whether it will work in US in the first place. All right? It is good for Singapore. It's ideal if Singapore is also experiencing a slowdown, which is obviously the contagion effect of the recession. And the appreciation of Singapore dollar, which is a key instrument for Singapore, will also assist to achieve the macro goals. Okay? This is one thing you take note. Okay? You may agree with it or not agree with it, but it's for discussion another day. It's one way for US. Money flowing out of US currency will be weaker, obviously. Okay? Lastly, okay, possibility of negative impact may be negligible because the Singapore government is very vigilant to do all these things. Overall impact, okay, weighing both things, Singapore believes that the effect will be more positive, all right, given the current environmental climate. Okay? All right. What the examiners have to say about this? Okay? Wide range of approaches to the second part of this question. It's good for them to discriminate the good students from not so good students. Okay? Understanding the impact of QE and interest rate policy. Well explained, analytical. Okay? All right? Okay. Hot money issues also raised. Okay? The errors to avoid. Okay? Singapore didn't do the QE. All right? Okay? And then, the growth in UK as a result of the policy change would lead to an increase in exports from Singapore to the UK. That doesn't happen. It's the other way around. Okay? All right. Before you go, Mrs. Tay has something to tell you.